Hey, welcome to the new video. Today, we're tackling a massive topic. In 2021, ProPublica revealed something shocking. Some of the richest billionaires in America paid a lower tax rate than the average middle-class worker. Not because they cheated, not because they broke the law, but because the tax system is designed in a way most people don't understand. If you earn a salary, you get taxed immediately. But if you build wealth through assets, the rules are completely different. Today, I'm going to break down, clearly and honestly, how billionaires legally reduce their taxes to almost zero. No conspiracy theories, no political bias, just the mechanics of how the system actually works. Let's get into it. Most people think billionaires make billions in income. They don't. That's the first misunderstanding. Let's say you earn $100,000 a year. That's income. You get taxed on it? Now let's say Jeff Bezos owns Amazon stock. If Amazon stock increases by $10 billion in value this year, did he earn $10 billion? Technically, yes. But legally, no. Because he didn't sell. And here's the key concept. In the United States, you are taxed on realized gains, not unrealized gains. If you don't sell the asset, there's no taxable event. So while your paycheck is taxed immediately, their wealth growth is not taxed at all until they sell. And most of the time, they don't sell. So, how do they access that wealth without selling? This brings us to one of the most powerful wealth strategies in the world. It's called buy, borrow, die. Here's how it works. Billionaires don't hold cash. They hold stocks, companies, real estate. These are assets that grow in value over time. Step 2. Borrow against them. If you own $5 billion in stock, banks are happy to lend you $200 million because you're extremely safe. If you own $5 billion in stock, banks are happy to lend you $200 million because you're extremely safe. And here's the trick. Loans are not income. Borrowed money is not taxed. So instead of selling stock and paying a 20% capital gains tax, they borrow money at maybe 3 to 5% interest, and they live off that loan. Private jets, mansions, new investments, all funded by borrowed money. No income tax. Step 3. Die. The step up in basis rule. This is the part most people never hear about. When a billionaire dies, their heirs inherit the assets. And under current U.S. tax law, those assets receive something called a step up in basis, which means the assets, cost basis, resets to the current market price. All the capital gains from decades. Erased completely. So if someone bought stock at $10 million, and it's worth $500 million when they die, the heirs don't pay capital gains tax on that $490 million increase. The value resets. That's how generational wealth avoids massive tax bills. This isn't illegal. It's written right into the tax code. Now let's talk about something controversial. Carried interest. This applies mostly to hedge fund managers and private equity executives. Normally, high income is taxed at up to 37%, federal income tax, but long-term capital gains are taxed at around 20%. Here's the loophole. Private equity managers often structure their compensation as investment gains instead of salary. So instead of paying 37%, they pay 20%. Let's do some simple math. If a fund manager earns $100 million, at 37%, that's $37 million in tax. At 20%, that's $20 million in tax. That's a $17 million difference. Legally, this loophole has been debated in Congress for years. But it still exists. Now let's talk about real estate. Real estate is one of the most tax-advantaged assets in America. Here's why. Even if a property increases in value, the IRS allows owners to claim something called depreciation, which assumes buildings lose value over time. So imagine this. A billionaire owns a building generating $10 million per year. On paper, they might show $10 million in income, but then claim an $8 million depreciation expense. So their taxable income? Only $2 million. This happens even if the property is actually rising in value. And there's more. There's something called a 1031 exchange. This allows investors to sell a property and buy another one without paying capital gains tax immediately. The tax gets deferred, sometimes forever. This is how large real estate empires grow without constant tax hit. Now here's an important point. This system wasn't designed specifically for billionaires. It was designed to encourage investment, encourage risk-taking, and encourage business growth. It was also designed to prevent double taxation. The idea is, if you invest in companies, create jobs, and build infrastructure, you get favorable tax treatment. The problem is the scale. When you apply these rules to extreme wealth, the benefits become massive. A middle-class investor gets small tax advantages. A billionaire gets exponential advantages. Same rules, different impact. And this brings us to the big debate. Some people argue, this is unfair. The ultra-wealthy should pay more. Others argue, these rules drive innovation and economic growth, and that's the real debate. It's not about secret illegal tricks. It's about how the tax code is structured and whether it should change. Here's the truth. Billionaires don't avoid taxes because they hide money in suitcases. They avoid taxes because they understand the difference between income, assets, debt, and tax timing. And once you understand those rules, you start to see the system differently. If this breakdown helped you understand something most people never clearly explain, subscribe. Because finance isn't about outrage. It's about understanding the rules of the game. And once you understand the rules, you can play smarter.